people, how are you? I hope you are doing fine wherever you are. Yes, we are continuing with our pursuit towards the ACCA taxation UK variant study journey. In the previous video, we looked at income taxes, computations in general, and we then dedicated much of our effort on property income. In this video, we are going to take a step further in the same series, the income taxes series, where we'll be looking at pension schemes and gift aid. Remember, we are based on the Finance Act of 2025, United Kingdom. All right, my name is Jerry Mutibukulu FCCA. Yes, I'm a fellow of the Association of Chartered Certified Accountants, and those are my numbers. You can get in touch with me on WhatsApp as well as direct call. So let's get into business. Now, by the end of this session, you should be able to compute pension relief. That is to calculate relief for both occupational and personal pension schemes. So there are two schemes we will be looking at with regards to pensions. There is what is called occupational pension scheme and personal pension scheme. Okay, occupational pension scheme, we normally abbreviate it as OPS, and the personal pension scheme is abbreviated PPS. Bear this in mind. You must be able to implement couple-based planning. Okay, this is where you should be able to minimize tax liabilities for married couples or civil partners using asset transfers and the transferable personal allowance. This is a rich exam graph. Always resident in our examination. Lastly, you must be able to execute income tax planning. That is, identify and mitigate high marginal tax rates, specifically the 60% tax tribe. All right, so if we cover these things, then we are ready to roll. Types of pension schemes, as I've already hinted, there is the OPS, that is the occupational pension scheme, and the personal pension scheme, PPS. The membership in these schemes usually vary, but you discover that employees are always, resident in both. So the membership for the occupational pension scheme is the employee. Employees are the members to this. Okay, and usually the tax relief method that applies here is a deduction from employment income. So the way they do the contribution is through direct deduction from their employment income, which means before any taxation, the contributions are directly deducted from the employee's pension scheme, and whatever tax that is going to be levied on this employee's income would then be levied, after the occupational pension scheme deduction has been made, which means the income of the employee, let's say if he earns 100 pounds, if he earns 100 pounds and he contributes 5 pounds, before we calculate any payee, we just have to deduct the 5 pounds, and payee is only going to be levied on 95 pounds. Right? So there is some tax benefit in this one, because instead of the payee being charged on the 100 pounds, it is only going to be charged on the 95 pounds. That's the idea of deducting this of the tax relief with regard to occupational pension schemes. In a way, they are mandatory. okay, this scheme is mandatory. The OPS is mandatory. However, the personal pension scheme also has got its advantages, as we'll see in terms of taxation, as we'll see throughout this presentation. The membership for the PPS is for those who are self-employed. The employees, again, can be members of this scheme, and even the non-income earners can also be, members of this. All right. Now, a dive further into this would be an understanding of who is going to contribute, and after they contribute, what happens. This will give us more closure or more understanding of these pension schemes. So let's start with the OPS, the Occupational Pension Scheme. The contributions here are made by employees and the employer, all right? So employers may contribute on behalf of their employees. The employees themselves, they contribute because, remember, they are the members to the scheme. The tax consequences here are that when the employer contributes, his contributions are not taxable on the employee, which means employer contributions are tax exempt. Employer contributions are tax exempt. I'm not going to be punished by those contributions the employer would have made on my behalf. Employer contributions are tax deductible against the employer's trading profit. So when the employer contributed something to me, something to my scheme or to the occupational pension scheme for the employee, he is allowed to deduct those contributions on his trading income to reduce the tax liability on his behalf, on the employer's behalf, right? So those are allowable deductions in the hands of the employer. Bear that in mind. Lastly, employee contributions are deducted from employment income. We have already spoken about this, where whatever a pay that is going to be charged, it is only going to be charged after the OPS has already been removed. This is going to reduce the tax burden on the employee. Now, the personal pension scheme, contributions are made by individual employees, their employers, okay? Even third parties might contribute on behalf of the employee or on behalf of the individual, right? So all those are the contributors to the PPS. Now, the tax consequences. Contributions are net of 20% tax. So it is presumed that when you make a contribution, okay, when you make a contribution, that contribution is considered an 80% contribution, right? Which means that 20% is going to be contributed by somebody else, and this somebody is the government. The United Kingdom government is going to put that 20% for you. So the individuals contribute the net amount, all right, and the extra, which is the gross. I mean to make it the gross amount, that there's a 20% that is going to be added automatically to the contribution. Don't worry, we'll do an example so that we illustrate this fact. So this PPS is going to extend bans by gross amount. Remember, we talked about the gross amount just in in the previous moment, we talked about the aspect of grossing up. So the PPS has got a consequence of extending the bands by gross amount of contribution to get extra tax relief via tax return if higher or additional rate taxpayer is the individual under review. So if somebody is a higher or additional rate taxpayer, there is an effect of extending the band. We normally know that this bands, for the higher rate starts from 37,701 to up to 125, up 125 something there. All right, so that's the higher rate, and after this 125, let me just show you the exact information. I don't want to to guess things. um, Let me just locate my text table. Okay, now this is what I mean, ladies and gentlemen. uh, there is the higher rate. Okay, this is the higher rate, and the range is this one, 37,701 up to 125,140. And the additional tax rate, additional rate taxpayers are those whose income is 125,141 pounds and over. All right, and their rates, the higher rate is 40%, whereas the additional rate is 45%. All right, so suppose this income earner, the higher rate takes the higher rate income earner, or taxpayer. Yeah, let me just say the higher rate taxpayer has got income, let's say 50,000 pounds. That income has to be subjected to, the extra above 37,701 should be taxed at 40%. But what happens is that if they contribute something like, say, 10,000 pounds, or let me just say 15,000 pounds, that 15,000 pounds into the PPAs has got an impact of allowing part of the, remember we said that if their income was 50,000 pounds, all right, and they contribute something like 15,000 pounds to the PPS. uh Part of the 50,000 pounds is going to be like the first 37,700 is going to be charged at 20%, which is the basic rate. And then the remainder, 50 minus 37,700, is going to be maybe 12,300. And this 12,300, because there was this PPS contribution, it means that this 12,300 is going to be at 20%. All right. And um, actually, yes, that's the idea. So it means that this 12,300 and the 37,700 are all going to be at 20%. So you can see that the band has been extended. The 20%, although it was supposed to end at 37,700, it is now being extended because there was a PPS contribution. There was a PPS contribution. That's the idea in general. Okay, that's the idea we are talking about in extending the text band. Okay, let me just get back to my notes. Now, scheme relief, the mechanism and computation. Tax relief depends on the type of scheme used. Remember, we've got two schemes: the occupational pension schemes and the personal pension schemes. Now, let's start with the occupational pension scheme. Here, the method that applies is the net pay arrangement. Relief. Contributions are deducted from gross salary before income tax is calculated. Remember, we talked about the payee issues. If an employee earns £50,000 and contributes £5,000 to an OPS, they are only taxed on £45,000. Relief is immediate at their highest tax rate. That is for the OPS. Now, the personal pension schemes, PPS, computation. Individual pays 80%, that is the net of the contribution. HMRC adds the remaining 20% basic rate tax to the pension fund. Higher or additional rate relief. This one is claimed by extending the basic rate band, 37,700, and higher rate band, 125,140, by the gross amount of the contribution. Pension limits. Total contributions are kept by two main limits. Number one, relevant earnings limit. Relief is limited to the greater of £3,600 or 100% of relevant earnings. For example, trading profits, employment income. All right. Some people are non-income earners. They are not employed. They are not doing anything. But to some extent, they have got some income. In that case, the relief will be limited to 3,600 if one he or she is a non-income earner, right? But if they're income earners, then the relief is going to be the higher of 3,600 or 100% of relevant earnings. Let's look at this example. Pension scheme and personal allowance. Donald has trading profit of £55,000. That's the trading profit. And he paid 2,400 net to a registered PPS in the tax year 2025-2026. Remember, this aspect of net contributions is related to PPS, not OPS. It's related to PPS. Now, show the tax benefits of this contribution. Calculate Donald's income tax liability for 2025-2026. Okay, now the benefits. Usually there are two benefits associated with the PPS. The first benefit is the free contribution or the automatic support from the government, from the HMRC itself. Okay. Remember, Donald paid how much? 2,400, and this was the net amount. Okay, so this was an 80%. Remember, the net amount is the 80% contribution. Then HMRC, His Majesty, Revenue and Customs, paid how much? That is the remainder. This is the 20%. So that's the 20 over 80. Okay, the 20 over 80 multiplied by 2,400. This means they paid something like 600, and we say this is the 20%, right? So what is the gross amount? The gross the gross becomes 3,000. Okay, so the first benefit is the free, the free help, you know, the free contribution from the HMRC. So in essence, he has contributed to the pension scheme. He has contributed how much? He has contributed 3,000. That is the gross amount which is going to be recorded in the PPS books. Donald has, you know, contributed 3,000, but in essence or in actual transactional terms, he has contributed 2,400. That is the amount that is going to leave his bank. However, the HMRC are going to assist him by giving him the 20% top up, for it to come to £3,000. So that's benefit number one. The benefit number two is on this guy's income taxpayer status. He is a higher rate. Okay, he is a higher rate taxpayer. Okay, so that is going to uh, assist Donald in a way. Yeah, that is going to assist Donald in a way. Okay, so the aspect of band extension, uh, we're going to extend the basic band, that is 37,700 plus the gross contribution. Okay, the gross contribution, which was £3,000. This means that the income here is that is 40,700 is going to be subjected to the basic rate. Okay, so basic band extension. All right. So when we are now computing this guy's taxable income, tax liability, there is a consideration to be made on the extension. So let's come up with the computations. First of all, we need to determine, to input the taxable income. Taxable income for this guy. From the question, we are told that he had these trading profits of 55,000. Okay. One might ask, why are we proceeding to taxable income before we consider the adjusted net income? The adjusted net income is essential because it tells us whether this person is entitled to a personal allowance or not. And the adjusted net income is actually, let me just use a different pen, the earning. The earning adjusted net income in this situation is the trading profits of 55,000 minus the gross pension contribution, personal pension contribution, which was 3,000. This gives us an earning of 52,000 pounds. Now, this one can tell us that the income here is less than £100,000. So this guy is entitled to a full personal allowance of 12,570. That's it. That's what it tells us. This Annie. Okay, so he's entitled. So if he's entitled, therefore we then have to then compute our tax liability. But for the computation of tax liability, please do not use the earning, but use the taxable income itself, that is the trading profit, and deduct PA, the personal allowance, which is 12,570. Okay, and this gives us the 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 taxable income. Using our calculator there, let me check my calculator here. Now that's 55,000 minus 12,570, that's 42,430. Right, this should be total income. Okay, now we then have to compute the tax liability. Okay, so we'll start with the basic uh, rate income. Okay, the basic rate. Remember, the basic band has been extended, and so this amount is going to be taxed at the basic rate. So we are going to say 40,700 at 20%. This should be 40,700 multiplied by 20%. That's 8,140. Then, okay, so this is the first. And then the second one should be the difference, that is 42,430 minus 40,700 at how much now? Remember, the basic rate has been consumed because we have extended this amount. This amount includes the 37,700 plus the extra extension, okay, which was 3,000 here, and we used up the 20%, right? And then we move on to the extra now. The extra above 40,000, any amount above 40,000 700 is going to be taxed at the taxpayer's higher rate, which is 40%, and that gives us 42,430 minus 40,700 close bracket multiplied by 40%. That gives us 692. And we sum up, we get our tax liability. The income tax liability of 8832. It's very, very, very easy. Okay, that's easy. Okay. All right. So one more thing here about the earning here. Um, the adjusted net income. The adjusted net income sometimes, uh, let's say, the profits for this guy were 100. This is actually a third benefit of subscribing or contributing to the personal pension scheme, where the earn itself might award you a personal allowance. Suppose the income here was 103,000 and the gross pension contributions were 3,000. It simply means that if we deduct 3,000, the income comes back to 100,000, which means this person will be entitled to a full personal allowance. Okay, will be entitled to a full personal allowance of 12,000. Will be entitled to a full personal allowance of 12,000, and you then start to do the computations where instead of putting 55 here, you will be putting the 103,000 and less the full 12,570. That's the idea. It's actually another benefit where the adjusted net income will be reduced by the gross pension contribution, and to some extent it might then give you the advantages of enjoying the full personal allowance of 12,570. Okay, that's the benefit. So bear that in mind again. Okay, let us proceed. Additional illustration. Raymond has made contributions of £14,000 into her personal pension scheme during the year. The gross amount of your contributions would be 17,500. Okay, remember when we are talking of personal pension schemes, we are talking of net contributions. You'll be contributing a net amount that is an 80% contribution, and HMRC is going to give you the other 20%. So in this case, this guy contributed £14,000, but in essence, he would have contributed the gross amount of 17,500. So suppose the taxable income of Raymond was £12,000. Okay, it means that he will be a basic rate taxpayer at 20%. So the tax relief is the 20%. The 20% relief given will be given as £14,000 treated as net amount of 80%, and the government is going to add 3,500, as we have seen here. That's the difference between 17,500 and 14,000. This should be 3,500. So the pension fund ends up with the gross amount of 17,500. One has been contributed by Raymond herself, and the other by the government, and they come up to 17,500. Now, a situation where Raymond is a higher rate taxpayer earning £52,000 of salary income, the rate that applies there is the 40%. All right. But the 40% relief is going to be given as 20% relief as per the basic rate taxpayer plus the 20% relief by extending the basic rate band from 37,700 to 55,200. Okay, how did we arrive at 55,200? That's 37,700 plus the gross amount that was 17,500, and this will give us the 55,200 we are seeing there. So there was a relief, isn't it? There was a relief. Tax relief on pension contributions. Tax relief eligibility. This is available on contributions up to relevant earnings for the tax year. These are the greater of 3,600 and 100% of trading income, that is profits from a business, employment income, for example, salary, income from property lettings, that is property income, which we dealt with in the previous video. The overall limit, there is going to be an annual allowance of £60,000. This one acts as a cap on gross contributions eligible for tax relief. For example, if an individual has trading profits of 50,000, then the greater of 3,650,000 will be chosen as relevant earnings. Okay, £50,000 will be the relevant earnings. If an individual has trading profits of 3,000, then the greater of 3,600 and 3,000 will be chosen as relevant earnings. 3,600 will be the relevant earnings. Okay, let's cement the idea of relevant earnings with this example. I hope by the end of this example, you would have had some firm understanding of what we are talking about. Isaac is self-employed, and for the year ended 31 March 2026, he paid £20,000 net, of course, into his personal pension plan. Isaac's relevant earnings for the year 2025-2026 were £110,000. What amount of income tax will Isaac pay at the basic rate for the tax year 2025-2026? So, we can see that Isaac was indeed a higher rate taxpayer, given the relevant earnings, which are above 36,000. The relevant earnings are above 37,000. Oh my God, what's happening? What's happening? Okay, I'm trying to look for a place to do some jotting, but seems like, hey man, what's happening? Doesn't want, it is not allowing me to write something. Oh my God, oh my God. What's happening here? Okay, so we're saying that 7,700. All right. So the income is above this amount, right? So the basic rate should all right. So the basic rate is actually between 1 to that amount. So that's where we pay 20%. This this thing. What's happening? Oh my God. What's happening? My God, my God, my God, my God. What shall I do here? What shall I do? My God. Hey, I think we just need to use and to let me try to share the screens. Perhaps if I do that, I might find somewhere to write because I need somewhere to write from. And I guess you're still seeing something. I guess the question is too visible. I just want to note. Yeah, I just want to jot something there. Question. Yeah, good. So, this guy's relevant earnings, the relevant earnings, relevant earnings are 110,000 pounds. Okay. So this is actually the higher of 3,600 and 110,000. So the relevant earnings is 110,000. Now, what amount of income tax will ASIC pay at the basic rate? Remember, the question is asking us that amount of tax which is going to be payable at the basic rate. But the examiner doesn't want you to compute. This is an exam tip. Please pay careful attention. The examiner is saying, tell us the figure which is going to be payable at the basic rate. And we all know that the basic rate is the 20%. Remember, I showed you the tables. I showed you this information from the text tables. The basic rate is 20%. Please bear that in mind. Okay, the basic rate is 20%. So we come here and say, first of all, we are going to pay the amount up to 37,700 is going to be at 20%, and also the gross contribution. Remember, he only contributed 20,000, which was the net amount. All right, 20,000 was the net amount. So the gross amount should be 20,000 multiplied by 100 over 80. That's the gross amount, isn't it? Let me use my calculator. Okay, that's 20,000 multiplied by 100 over 80. That comes to 25,000. Okay, this comes to 25,000. So you need to add up. So these are the figures which are going to be taxed at 20%. So that's 37,000 plus 25,000. 37,700 plus 25,000. 37,700 plus 25,000. That's 62,700. Okay, so this is part of that, so you can see that the basic rate band has been extended from 37,700 to 62,700, which is going to be at 20%. So what is the tax liability at 20%? Remember, the remainder was going to be paid at 40%. Because he's a higher rate taxpayer. But in this case, the question wants us only to consider the amount of tax payable at the basic rate. So these are the basic rate figures, the 37,700 and the gross amount of 25,000, which is going to be 62,700 multiplied by 20%, multiplied by 20%. So that is going to be that's 62,700 multiplied by 20%. That's 12,540. 12,540. And that is our answer. So that is the amount payable at the basic rate, and the basic rate is 20%. Okay, now for the relevant earnings, we have seen that the relevant earnings in this case were 110,000, which are higher than 3,600. Okay, so the relevant earnings were 110,000. Okay, now of those relevant earnings, 62,700 are going to be at 20% tax rate, and the remainder will be at 40%. Please bear that in mind. Bear that in mind. Okay. That's it. That's it. So the answer is 12,504. So when you are inputting, please do not put any comma. Just put the figure 12540 in the box. Don't put any comma. Don't put any comma. Is that clear? Good. All right. So we have cleared the picture on relevant earnings. Let us now proceed. Hey, where are you, slideshow? Now, the annual allowance. We have seen in the previous example that the relevant earnings matter. Also, the pension contributions which an individual would have made would have got the impact of extending, these tax bands. Um, there is a relief which is normally given uh, with regards to these pension contributions. All right. That is what is called the annual allowance. So we have seen in the previous page here that the annual allowance is the overall limit on those gross contributions which are eligible for tax relief. So for the year 2025 to 2026, it is £60,000. An individual can use the allowance yearly, and the amount unused is carried forward for 3 years, but only if they are a member of the pension scheme in those years. Therefore, at any particular time, an individual can use their current year allowance plus 3 years balance brought forward unused annual allowances on a FIFO basis, which means the first year has to be cleared. The earlier year has to be cleared, then the second up to the current year. All right. The gross contributions are deducted from the annual allowances. So these annual allowances for the past, 5 years. 4 years. Okay, this one is the current. So let I just say for the past 5 years, it's fine. So now, we are going to use these figures as we proceed. Now, contributions exceeding the annual allowance. Sometimes somebody contributes 70,000. Excuse me. Contributes, say, £70,000. So this amount, it means that the 10,000, which is the difference between 70 and 60, the 10,000 is going to be subjected to a charge. This charge is taxed at the individual's marginal tax rate. If he is a higher rate taxpayer, we are going to charge him at 40%. If he is an additional rate, we'll charge 45% as a tax charge, effectively removing the tax relief on excess contributions. Let's look at this example. John's business profits for the tax year ending 05/04/2026, that is 5 April 2026, were 95,000 pounds. He contributed 85,000 gross into a personal pension plan during the same tax year. So if the examiner tells you that the contributions were gross, simply means that you need not to gross again. You need not to gross up again. So in previous tax years, he made gross pension contributions of 35,000 in 2022. Okay, so if the question is saying how much of John's pension contribution qualifies for tax relief, it is telling us that certain time, in many times, the individual's contribution or pension contributions might not be qualifying for tax relief. All right. Um, remember, we were told that the aspect, the relevant earnings have to be considered, which are the higher of 3.6 or the person's relevant earnings. Okay. Um, I mean, for contributions to qualify, they need to be the greater of 3,600 or 100% of the person's income, be they trading profits, property income, and so forth. All right, but up to 60,000 pounds. Now, here we can see that the contributions which were made were 85,000, which is gross, and these ones were greater. I mean, the income was 95,000, which was greater than 3,600. So the relevant earnings here, which we are going to use, are the 95,000. Okay, those are the relevant earnings which we are going to use as applicable in this case. All right, and this person has been a member of the pension scheme for all these years. All right, he has been paying, he has been contributing to the pension scheme, these gross amounts. So our duty here now is to determine whether this 85,000 gross is qualifying. Is it qualifying? How do we know that? All right, a look at it directly would suggest that only 60% of this in the current year applies, but the 15% doesn't. All right. So we then have to ask ourselves, were there no other unused before we utilize this current year's allowance? Were there no other unused allowances in the previous years? All right, so we start with the year which he contributed, which was the 2022-2023 year, and we were given these amounts. For the 2022-2023, we are using 40 and then 60 up to the current. So we come here and say for 2022-2023, you contributed, the annual allowance there was 40,000, but he contributed 35,000. So the unused allowance is 5,000. So he's going to first utilize that one. And then for 2023-2024, that was now 60,000, and he contributed 35,000. The unused becomes 25,000. For 2024-2025, it was now 60,000, and he contributed 55,000. The unused is equal to 5,000. Okay, so total allowances available. Total allowances available would be this year's allowance, which is, the current year's allowance, that is the 2025-2026 year allowance, that is 60,000, plus the total here, the total that's 35,000, isn't it? 35,000. So plus 35,000. This comes to 95,000. So these are the allowances available. So it simply means that the 85,000 here we are looking at is wholly qualifying. So 85,000 pounds wholly qualifies for tax relief. It is qualifying for tax relief. So which means we will then have to utilize this one in our band extensions, right? It will be utilized, it will be used in the band extension computations. All right. So in this case, if we want to determine the band extensions, given that his income were 95,000, we can now safely do the computations. Okay, bear in mind that we are now going an extra mile to this example, but it was not the requirement. The requirement was just for us to determine that the 85,000 gross contribution there was applicable. Okay, was qualifying for tax relief. However, the question might then ask you to determine the tax liability, okay, or the taxable income here. So what you need to do is to be systematic. First of all, you need to establish if this person is qualifying for the the personal allowance. All right, and yes, he qualifies because he qualifies for the full amount, because 95,000 is actually less than 100,000. So first of all, you then have to say income or total income, that is 95,000, then less personal allowance of 12,570. You get how much here? Let me use the pen, the calculator. 95,000 minus 12,570, you arrive at 82,430. This becomes the taxable income. Now let's compute the tax liability using the taxable income of 82,430. We come here and say, okay, because we know that 85,000 is gross. So in that case, we are going to say actually is everything here, because the taxable income is less than the gross contributions. So it simply means that everything here is going to be taxed at 20%. Remember, these contributions to a pension scheme, the gross amount is going to be taxed at 20%. That's the rule. So if the taxable income is less than the gross pension contributions of 85,000, then it simply means that everything, the tax liability there is simply going to be 82. Oh my God. So it doesn't want me to play around that area. So everything here is going to be the tax liability is going to be 82,430 multiplied by 20%. and you get your answer. That's the computation, ladies and gentlemen. So the relief is in the reduced rate of tax. So 82,430 multiplied by 20%. So it means that the tax to be paid, that's 16,486. Okay, I hope I said much about this example and so far. Um, so that is it. So this is the answer, and we determined that £85,000 was applicable. Now let's talk about tapered annual allowance. When is the annual allowance going to be tapered? So higher earners 25-26 year annual allowance starts at £60,000, but it is reduced by £1 for every £2 of adjusted income above £260,000, with a minimum tapered allowance of £10,000. Sometimes these there are income earners who earn, let's say, something above 360,000. If your income is greater than £360,000, then you are entitled to an to a tapered allowance of £10,000. This is done to to at least motivate the higher income earners to enjoy some allowance. All right. So adjusted income is equal to, this is an example where an individual's adjusted income is £360,000. The annual allowance available would be the 60,000, the current year annual allowance, minus 360 minus 260 divided by 2, and you see that they get £10,000. All right. But even if the annual income, adjusted income, is above 360,000, it will still be £10,000. All right. That's the idea. Now, for the tax year 2025-2026, what is the annual allowance for an individual with an adjusted income of 410,000? We say that that's £10,000. Now, Juliet has a trading profit for 306,000. She has never previously been a member of pension scheme. What is Juliet's tapered annual allowance? Tapered annual allowance, that's 6,000 minus the income minus 260, which is the benchmark. Remember, the annual allowance is available for individuals who earn income up to 260,000. So if your income then gets above that, you need to have a tapered allowance. Let me just take a call. So Juliet ends up with a tapered annual allowance for 2025-2026 of 37,000. The aspect of carried forward, we talked about this, okay, but there is something of interest, which is the annual allowance charge, which could be of interest to us. Emily's pension contributions, she contributed that much in 2022, 2023 year, 32,000, 40,000, 69,000 for the current year. And her adjusted income was 150,000. Now, will Emily be subject to an annual allowance charge in 2025, 2026? let us look at these things step by step. All right. So the standard allowance for 2025 is £60,000. Emily's 2025, 2026 contribution were 69,000. So there was an excess of £9,000. Okay, so she contributed more, 69, or I mean against 60. So that's the 9,000 was an excess contribution. So we need to check for carried forward allowances. So we need to check for carried forward allowances. So far, we have determined that there was an excess contribution which should be subjected to an annual charge. Okay, in annual charge, or I mean, an annual allowance charge. So let's carry forward. Let's look at the earlier year, that is the 2022-2023 year. The standard allowance was 40,000 and contribution was 33,000. So there was an unused allowance of £7,000. For 2023-2024, standard allowance was 40,000. Emily's contribution was 32,000. So the unused allowance was 8,000. Okay. Here we need to verify. I need to verify it should be. It should have been. The standard allowance was supposed to be 60,000 here. All right. Anyway, that's for the purpose of learning. You'll be given these figures for previous years in the examination. So do not worry. What you need to know is how to treat, how you to utilize those figures. Then for the 2024-25 year, standard allowance 60,000 and Emily's contribution 40,000. So therefore, the unused allowance is 20,000. So using carried forward allowances, Emily's 9,000 excess is covered. First of all, in the earlier year, remember we used the FIFO method. So the earlier year, 7,000 has to go first, then followed by the 2,000 for the 2023-2024 year. Remember the 2,000. Was it okay? The 2,000 from the 8,000. Remember, 2,000 from the 8,000. So obviously the 6,000 is going to be left unutilized. Okay. So Emily uses all of her 2022, 2023 carried forward allowance and a portion of her 2023, 2024 carried forward allowance. Conclusion: no allowance charge. All right. Emily will not be subject to an allowance charge in 2025, 2026 year. Remaining unused allowances, that's the remainder, the 6,000 and the 2024, 2025 of 20,000. These remaining allowances can be carried forward to 2026, 2027. Okay, good. Don't worry. I mean, don't say, what about the 60,000 currently? The 6,000 has already been utilized when we determined the 9,000 excess here. That's 60 minus 69. Remember that. Okay, what about this example? Jerry D made the following. Oh man, I like Jerry because I'm Jerry also. Jerry D made the following gross amount of contributions into his pension scheme in earlier tax years. Okay, 2023, 2024, 2024, 2025. That's okay, 62, 30, and 25,000 in the current year. Jerry D has an annual salary of 120,000. Compute the total pension input allowed for Jerry D for the 2025-2026 tax year. Okay, now let's do the computations. Okay, now to establish the total pension input allowed, total pension input allowed is that amount that is going to be considered as the gross pension contribution for an individual for tax purposes. Remember that amount, that gross amount that is going to extend the tax band, okay, or to extend the the usage of the 20% rate. Okay, so we want to determine, first of all, remember we need to consider the current year annual allowance, which is 60,000. Obviously, it's going to be there. Then the previous years, we need to consider if for the 2023, the contribution was 62,000, but the allowable was 40,000. Okay, was 40,000, as we have already seen. But I still want to verify this. It could be 60,000 again. Yeah, because the 60,000 have been, I think, three have been used 3 times now. So whether 60,000 or 40,000, the impact is still the same because the contribution was higher than the allowance, which means the whole allowance was used up. So for the 2023-2024 year, there is new outstanding, new unused allowance. What about for the 2024-2025 year? The annual allowance was 60,000, which was allowed, and minus 60,000. So it simply means that here we are having 30,000, which is unused. 30,000 unused, and then here it's 60,000 for the current year minus 25, so which means 35,000 is unused. So the total unused becomes 125. 125,000 is unused, okay, against a salary of 120. So therefore, this 125 becomes the gross contribution, the gross pension contribution, or the maximum gross contribution that is going to be allowed. Okay, gross contribution, gross pension contribution allowed. So if the income is 120 and the contribution is 125, it simply means that all the income here is going to be taxed at 20%. That's what it simply mean. Yeah, that's what it simply means, that everything here is going to be taxed at 20%. However, the answer to the question was that 125 was going to be the maximum contribution allowable. Okay, to be allowed for that band extension. The band extension, when we are now computing the taxable income, it simply means that everything, right? Or after considering the personal allowance, 120 minus personal allowance, you then have to, you'll be left with something here. You'll be left with something. Then that something is going to be taxed at 20%, something like that. One would start to wonder, to say, okay, fine, if it is 120, therefore this person is not entitled to the full 12,570 personal allowance. In this case, because there was a growth, a pension contribution, okay, there was this contribution which was made to the pension scheme, to the personal pension scheme, rather. It simply means that, the income, the adjusted net income in this case, is going to be entitled to the personal allowance. It is going to be entitled. So this 120 is to be reduced by the personal allowance, and then whatever income that is left is going to be subjected to the 20% tax. Anyway, I admit we'll verify, but that is the position at the moment. I'll update this part when I get more information to the contrary. But at the moment, please stick to the principle, all right? Because we have subscribed to a personal pension scheme, so therefore we need to then say 120 minus the amount that was made to the pension scheme. And you can see that the amount made to the pension scheme is greater than 12,570, which actually means that is greater than this 120,000. So automatically it simply reduces everything. Uh, uh, I mean, it reduces the income to zero in uh, income terms, okay, to negative 5,000. So in that case, it simply means that the personal allowance um, was to be deducted there. He is entitled to the personal allowance, but is he entitled to a personal allowance on a negative income? Oh, tax issues. These are tax issues now. Obviously, we don't give personal allowance to negative income. All right. Um, so in essence, all right. So in essence, um, because it is an advantage, okay? It is an advantage. Remember, adjusted net income is just an apparition. It's an apparition. It's not really a cash flow. So what then happens is that it simply tells us if the person is entitled to a personal allowance or not. So in this case, as this gross pension contribution or the gross or the total pension input is higher than the income there, it has got a tendency of reducing the income earner from a higher income taxpayer to a basic one. Then, therefore, this person is entitled to the personal allowance. All right. So first of all, you deduct the personal allowance, and then whatever that is left, it is now then has to be charged at 20%. That's the idea. That's my explanation. Okay, the carry forward. Dembele's made the following gross personal pension contributions. Okay, so these are the contributions. Dembele's adjusted income for the tax year 2025-2026 is 390,000, but for previous tax years, he did not have sufficient income for his annual allowance to be tapered. Dembele's tapered annual allowance for 2025-2026 is the minimum of £10,000 because his adjusted income exceeds 360,000. 40,000 minus 31. Okay, so here, that's, I mean, for 2023, 2024, that's this much, uh, 31,000 minus 40, that's 9,000. And then from 2023, 2024, it is 2023, 2024, that's 60,000 minus 39. My years are not corresponding, are not moving in tandem. Anyway, that's 21,000. And then for 2024, 2025, that's 1,000. Okay, which is 10,000 minus 9,000. Okay, remember 10,000 is because the current year, the minimum allowance applicable is 10,000. So that's 10,000 minus 9,000. We come to 1,000. So from 2025, 2026 to carry forward, we need to carry forward to 2026, 2027, a total of 9,000 plus 21,000 plus 1,000. That is 31,000. Anyway, I'm sorry for the years which were not captured properly there. Hello? Now, example kit here, example kit is fundamental to our learning because it gives us more integration in terms of how these annual allowances are going to affect the income tax liability. So far, we have been dealing with the aspect of the relief um, as it affects the you know the extension of the brackets or the tax bands. But now we want to see the ultimate tax liability computation so that everything would be brought to the same page. Keith had taxable income of 95,000 pounds in the tax year from his employment. He made a gross personal pension contribution of 74,000 during the year. He does not have any unused annual allowance brought forward, and will have 60,000 pounds annual allowance available this year. So the examiner is telling us that we need not to consider those previous year unused annual allowances, but the only available allowance is the current year allowance. All right, so first of all, we need to establish our income. What is our income? The income here has been said to be taxable income. Taxable income is a figure that is arrived at after deducting whatever personal allowance this individual was entitled to. So in that case, do not redo or reapportion the personal allowance. Please be mindful of the terminologies. The terminology. Taxable income is that figure we first of all have total income, then we less the personal allowance, we arrive at the taxable income. So in this case, we are starting, excuse me, that zone is not allowed. So we are starting at taxable income, and this was given as 95,000. The taxable income. All right. So, any taxable income, that's when we go to the tax liability computation. But we were told that this person contributed to a pension scheme. How much? 74,500, and this was a gross amount. It wasn't a net. So do not gross it when the examiner has told you that this is a gross amount. So what you simply have to do is to add, to extend the basic rate band. The basic rate band has to be extended. The basic rate starts at 37,000. Ends at 37,700. Okay. Okay, so we then have to add the gross contributions of 74,000. This comes to how much? 111,700. Please verify with your calculators. Now, it simply means that because this amount is greater than, the relevant income of 95,000, the relevant earnings of 95,000. So it simply means that the whole 95,000 is going to be taxed at, so 95,000 pounds is going to be taxed at 20%, the full of it. This means that we are going to have a tax of 95,000 multiplied by 20%. That's 19,000 to 19,000 only. All right. Now, we know that this 74,000, the 74,000 was above the annual allowance of 60,000. Remember, this person did not have any other allowances in the previous years. So the only allowance that was available was 60,000. So it simply means that the extra has to be subjected to an annual allowance charge. So let's compute the annual allowance charge. Annual allowance charge. The annual allowance charge is the difference between 74,000 gross contributions minus 60,000. Okay, multiplied by the tax rate, the taxpayer's rate. Here, the taxpayer is paying the taxes at what rate? He is paying the taxes at 20%. So that's the idea. So the excess is going to be at 20%. So that's 14,000 multiplied by 20%. That comes to 2,800. So the tax liability is going to be the sum of these two figures, and that is 21,800. Okay, now while tax relief is allowed up to relevant earnings, the annual allowance limits tax relieved contributions. So it simply means from this example that although this information, the basic rate extension is going to allow the taxpayer's income to be taxed at a lower rate. Okay, the whole of the income is going to be taxed at a lower rate. There is also going to be a charge if the gross amount of contribution is exceeding 60,000. There is going to be a tax charge. Okay, that's the tax charge, which even if you enjoyed the 20% on most of the income, you are going to be subjected to a tax charge there. Okay, good. If it wasn't this, if the 60,000 limit was not given, people were going to contribute as much as they want, and by the end of the day, the taxman was not going to get anything. Yes, it is a good social protection technique to ensure that the citizens subscribe to pension schemes, but the taxman needs some cash flow. The government needs some cash flow. So these limits are essential to ensure that the government still has got some cash flows to rely on. Okay, now exceeding the AA, contributions over the AA or tapered AA trigger an annual allowance charge. This charge ensures excess contributions do not benefit from tax relief. Minimum allowance protection, the 10,000 pounds tapered allowance is the floor, ensuring some level of tax relief even for high income earners. They are also entitled to that. Tax planning aspects, these ones are just things which we need to consider, and we will read them through the notes. I'm going to supply you the notes. Please read around everything. Okay, read everything around this area. The notes are on their way. They're going to be in your on your portal. Now let's talk of the gift aid. The gift aid treatment. The gift aid scheme. All right, what are they, or what is it? Gift aid is a UK tax relief scheme that allows charities to claim back 25% of donations from HMRC. It applies to donations made by UK taxpayers who have paid at least as much tax as the charity will claim in the tax year. When an individual donates £8, the charity claims back £20 from HMRC. making the total donation £100. This is equivalent to 20% tax relief because it assumes the donation was made from pre-tax income. Higher rates, 40% and additional rate, can claim a further tax relief through self-assessment. Charities receive extra funding at no additional cost to the donor. Higher earners reduce their tax liability by extending their basic rate tax band. Gift aid donations low adjusted net income, potentially restoring part or all of the personal allowance if earnings exceed 100,000. We have talked about this previously when we looked at the pension, the personal pension scheme impact, where the earning sometimes is going to be reduced to such an extent that the taxpayer would be entitled to the full personal allowance or part of it. Tax planning tip: if your income is over £100,000, making gift aid donations can help reduce your effective tax rate by lowering adjusted net income. Let's look at example Rohan. In the tax year 2025-2026, a freelance web developer, Rohan, generated a substantial profit of 103,000 from his online business. He also earned income from a variety of investments, okay, including £7,000 interest from high yield savings account. So this one is a savings income, and 9,000 dividends from his portfolio of technology stocks. So there is also dividend income. Rohan had taken out a loan to fund his entry into a collaborative tech venture and paid £5,000 interest on his loan during the year. Furthermore, he is a regular supporter of a local children's charity, making a 12,600 net donation through the gift aid scheme. Calculate Rohan's total income tax liability for the 2025-2026 tax year. So this is a very important example because it actually brings together everything we have covered even in the previous video or videos on income tax computations. So it's a wonderful, wonderful, essential video component we need to pay careful attention to. Okay, so a text table is very, very, very important here. We need to have that table. Okay, before we come up with the table, there are two fascinating facts. Two fascinating interests here which have to be discussed upon. There is interest from high yielding savings account. This is interest income and it is savings income, but there is also interest which was paid on a loan. This one is normally called qualifying interest. Qualifying interest. It has got a tendency of reducing non-savings income. It is an allowable expense that reduces non-savings income. So I thought it was very, very important for us to consider that. All right, now the text table. What is the time now? Okay, so our text table, we are going to have how many columns? I think there are 4 columns. This is non-savings income. Okay, everything is in pounds. Then we come to savings income. dividend income. Then we get our total. Okay, so the incomes are going to be taken from the scenario itself. So there was substantial profit from his online business of 103. So that's trading income. $103,000. Okay, that's a non-savings income. And what else? He earned income from savings. So that's bank deposit. Bank deposit interest. That was 7,000. Then dividends of 9,000 from his portfolio. So dividends 9,000. So these are the incomes we total up. We get, so everything has to be totaled. So that's I mean 103,000, 7,000, 9,000. Okay, and we total up, we get the total income. Is the total income, ladies and gentlemen. That's 103,000, 7,000, 9,000, and we need to add up here. That's 3, 10, 19, get 1, 1. So that's 119,000. Okay, and we then have to reduce the total income by some reliefs, less reliefs. We have got the qualifying interest. Qualifying interest here was 5,000. Remember that loan interest payment, 5,000 there. Okay, this comes to 5,000 here, right? And we get our net income. So here we are now at 98,000, 7,000, 9,000, and here that's 114,000. So what normally happens is that when you arrive at the net income figure here, you then have to proceed to the personal allowance deduction. Now, you may be tempted to say this person is not entitled to a full personal allowance. Why? Because his ultimate income, his net income in total is above 114,000. Please do not look at single type of income, that is the net savings income, and tell yourself that this person is entitled to personal allowance. No, it doesn't work like that. You need to consider this figure in the total column. The figure in the total column. If there was no qualifying interest, we're going to look at this figure. But at the 119, but because there is a qualifying interest, we are then going to look at the 114 figure here. Now, well, this person is appearing to not be entitled to the personal allowance, the full amount, but because he made some donation, okay, he made some donation to a pension scheme, where the donations? Yeah, he made. He made a gift aid, a gift aid donation, which was 12,600 net. So we need then to compute the adjusted net income to see if he is entitled to the full amount of personal allowance or not. It's very, very, very important. It's very important. So the amount we are going to look at now is the 114. Okay, the 114 as the total amount there of income, right? That is the net income of 114,000. All right, less minus the gross gift. Gross gift here, the gross gift, the net was 12,600. So multiplied by 100 over 80. That is going to give us the gross gift. 12,600 multiplied by 100 over 80, that comes to 15,750. And this means that our earning is going to be 98,250. This is the adjusted net income. So it means that this person is entitled to a full personal allowance, because every income that is below 100,000 is entitled to this. So we come here and say personal allowance 12,570. Okay, and we get the amount, which you can say in the exam, you can say working number one, so that you show them the workings on the adjusted net income workings, because that one is going to attract some marks for you. Okay, so 98 minus 98,000 minus 12,570. This means that the taxable income is going to be 98 minus 12,570. This means maybe this calculator of mine, what is it showing? 85,430. 85,430. And the rest of the figures, you can just import them as they are. Okay, and here, be mindful, you need to deduct 12,570 from 114. And what you get 101,430. Now, from the taxable income, you move on to the computation of the tax liability. The tax liability. So, you need to ask yourself, in the computation of tax liability, we start with the best rate band. Okay, the best rate band. But the best rate band has been extended because there is a donation to the gift. There's to the gift aid scheme. So the extension should be 37,700 plus the gift which has been grossed up, and the grossing, we did the computation already, and we determined that 12,600 multiplied by 100 over 80 was 15,750. This is the amount of gross we are looking at. So that's no need to put a bracket there. No need for bracketing. 15,000. That's 15,750. Okay, so okay, I think, yeah, we then have to multiply this by 20%. What do we get? That should be 10,690. Okay, that's the best rate. The total here is essential. Sorry, the total is essential because you need to verify your figures. So that comes to 53,450. That's 37,700 plus 15,750, right? So, but remember, the total figure we are looking at here is this one. This is the figure we are doing all these computations for. So everything the figures have to add up to that amount. Okay. So, so we have done this 53,000. We subjected it to 20% tax, and we obtained that one. Now we then have to tax the remainder, okay, the remaining figure. All right. All right. So the remaining figure, remember, we are starting to tax from the non-savings. Non-savings. Okay? The non-savings income. What's happening? We are taxing the non-savings income first. So the non-savings income, 53 has been utilized. How much is left? The non-savings income was 85,430. So you need to do 85,430. There's a call. Okay, so that's 53, 53, 450 minus 85, 430. We are left with 31,980, and this should be multiplied now by the higher rate, which is now 40%. So that's the portion that is going to be subjected to the higher rate, which is equal to 12,792. Okay, that's the higher rate portion for non-savings income. Now we move on to the savings income. Savings income. There is the new rate band for savings income, which is 500 from the tables. Okay, 500 is going. The 500 is going to be new rate at 0%. It's very important to write these figures, and then for the remaining of, remember, savings income, we are looking at 7,000. So 500 has already been subjected to 0%. So the remainder is 6,500. This one is at the taxpayer's highest marginal tax rate, that is 40%. Okay, so 40% there comes to 2,600. We are done with the savings income. Let's go to the dividend income. The dividend income, ladies and gentlemen, is also subjected to some new rate. The new rate band, which is the 500. That's 500. So from this 9,000, we are going to first subject to the 500 at 0%. If this person was a basic rate taxpayer, for the savings income, the first 1,000 was going to be at zero, okay, at 0%. But now he's a higher rate taxpayer, so he is only going to be entitled to 500. For the dividend, that's 500 at 0%. That comes to zero, and then the remainder, which is now 8,500. Okay, 8,500. But now we are not going to utilize the percentages as we did on the savings income, but for dividends, the the law is very, very specific there. For dividends, let me take you back to the tax tables. All right. For dividend rates, the dividend rates are specifically given by the examiner, and we need to utilize them. So if somebody is a higher rate taxpayer, then we need to use 33.75 percent. If they are basic, we use 8.75. If there are additional rates, that's 39.35. So please pay careful attention there. So we come back to our presentation. So at 33.75. So that's 2869. So we add these figures and we arrive at the total our T, which is 28,951. So that's how these computations are done. We have seen the impact that gift aid schemes is just the same as the personal pension scheme. The personal pension scheme, the PPS. They're just the same. Guys, I hope I've done justice to you. I think I'll do one extra example for you, which is a bit comprehensive, so that you are assisted accordingly. Okay, guys, let us do this example where we are going to look at a situation where both the personal pension contributions and gift aid donations are involved. For the tax year 2025-2026, Kyla has a trading profit of £159,000. So that's the trading profit, ladies and gentlemen. And she decides to make tax efficient contributions by paying 32,000 net into her personal pension scheme and donating 9,600 net to charity and gift aid. Calculate Kyla's adjusted net income after considering her pension contributions and gift aid donations. So this one should be very, very simple, because we say that when we are calculating earning adjusted net income, we just have to say equal sign the basic income, that is the trading income, plus the grossed, not plus but less grossed amounts, minus gross amounts, minus the two gross amounts, that is the the contributions to the pension scheme, as well as the donations under gift aid. Okay, so those two gross amounts have to be, so it's minus gross again. That is, the first gross is for the pension, and the other gross is for the gift aid, the G, small g there. Okay, and you get your adjusted net income. Then you need to determine the personal allowance, if any. That one is dependent upon the earning. The earning will tell us if it is less than 100,000, then it means that this person is entitled to the full amount. But if the earning is between 100,000 and 125,000, thing 140, then what you need to do is to reduce the personal allowance up appropriately. Yes, there is a way of, because any increase of £1 uh, for uh, for £2, okay, per £2 is going to lead to a decrease in the personal allowance. All right, so we'll show how that one works. Then you are required to compute Kyle's taxable income after applying any available personal allowance. Then you need to compute the income tax liability for the year. So this is actually the process you have to undergo when you are intending to compute the income tax liability. So these questions should be a shock. All right. So this is the solution. Um, First of all, we were required to compute, the adjusted net income. However, like I said, you need to first of all, because when you calculate the adjusted net income on point number 2, the note number 2, it is the trading income, which was 159,000, the trading profit, less the grossed amount. But how do you compute the grossed amount? Remember, there was a gross contribution to be made to the personal pension scheme, and we were given the net amount of 32 multiplied by 100 over 80, and we get this as the gross for pensions. And then another gross for the gift aid donation is going to be 12,000, which is the net amount 9,600 multiplied by 100 over 80, and we get the 12,000 there, which is the gross amount for the gift aid. So these are the figures we need to deduct here. This one was for the pension, and the other one there is for the gift aid gross amounts. So Annie therefore comes to £107,000. But the earning is above 100,000, so we need to then compute the personal allowance. Remember, initially the personal allowance should be 12,570. However, it is going to be reduced by 107,000 minus 100,000. Okay, divided by 2. Okay, or divided by 2. So this means that there is 7,000 over 2, which means that the the amount in the bracket should be 3,500. All right, and this one has to be deducted from the 12,750, which 570, which is the personal allowance full amount. So it means that the remaining personal allowance should be 9,070. So this is why we say that the personal allowance there is 9,070. All right. Why? Because this person, the person's income is above 100,000. So when it's above 100,000, the personal allowance is going to be reduced. It's going to be reduced in a proportionate way or proportionate manner. Okay. Um, that is it. So This is the 9,070 you are seeing there. That's the personal allowance this person was entitled to. So this is now used to reduce the original trading profit, which was 159,000. Okay. So the original trading profit is going to be used when we are computing the income tax liability. So we are going to use the original, okay, and we deduct the personal allowance, and we arrive at the taxable income, which is 149,930. This is the taxable income which we will use to compute the tax liability. So um, the basic rate band has been extended, okay, by how much? By those gross amounts, the two G's, remember, the 40,000 and the 12,000, okay. Uh, so that's 52,000 is going to be added to the 37,700, so such that the income, this particular income, is going to be taxed at 20%. That's what you are seeing there. Then the remainder, remember, by the end of the day, everything should add up to 149,930. That is the figure which is taxable. That's the taxable amount, the taxable income. Okay, so if you add these figures, that's 37,000, 52,000, 60,230, they should come to 149,930. That's the figure if you want to cross-check yourself to ensure that everything has been catered for. So the balance here, we say that it is now taxed at 40%. So these are the resultant tax figures, and the total tax liability is 40,032 pounds. Okay, you can pause the screen and attempt this one on your own. Ma had the following income and outgoings in the 2025-2026 tax year. Okay, so in other words, we are being told of Emma's, inflows and outflows. Okay, the income and outflows. All right, there was trading profits of 42,000, employment income and payee of 550 had been deducted in respect of this income. Okay. Bank interest received 4,200, dividend income 8,500, qualifying interest paid 1,200. Remember, this one is relating to a loan you would have taken. All right, so it is allowable as a deduction. Okay, it is an allowable deduction. Gift aid, the amount which was paid was 2,500. So if you pay this one, obviously there is the aspect of grossing up which has to be done. Calculate the income tax payable by Emma for the 2025-2026 tax year. We have this information here. Obviously, we are now accustomed to this table, and we just have to be comfortable with it. That's the best way to present the information. We are given information on non-savings, savings income, and dividend. Okay, the scenario will tell you whether you need that table or a modified version of it. Okay, here that's how we extracted the table. This one is non-savings income. This one again is non-savings income. Bank interest received, that's savings income. Dividend income, that's dividend income. So this is how we come up with the three columns, and the fourth column was the total. So the two non-savings income, the trading profit for 2000, employment income 9,500. We add them up, we get the total income. The bank deposit interest was 4,200. This one, yes, that's 4,200. And the dividend income was 8,500. We just take it as it is, 8,500. So you always remember to insert everything which you have inputted in these columns in the outer column. Okay. The total incomes are given 42 plus 9.5, that's 51.5. That's for 4,200, that's 8,500, that's 64,200. Okay, we then have to reduce the total income by the qualifying interest. Okay, this one was qualifying, it's an allowable deduction. So it means that the net income becomes 50,300 and the other figures remain the same except for the outer column, which also requires some adjustment. So here we can see that the net income being 63,000, it simply means that this person was a higher rate taxpayer. However, we then have to ensure using our computations for Annie to determine if this person is entitled to the full allowance. The 63,000 obviously would have shown us, but it's good practice to first of all compute the Annie. Okay, it is good practice. Adjusted net income. All right. When we compute the adjusted net income, we say that it is the total income. Okay, the total income. In the exam, the best way to determine whether it is essential to compute the earning is to look at this figure, that is the net income figure, before any personal allowance is computed. If it is less than 100,000, no need to waste your time trying to figure out if the individual is entitled to the full personal allowance. Why? Because already you know that when it is less than 100,000, the person would be entitled to the full personal allowance of 12,570. All right, so there won't be any need for any computation. However, for interest sake, the earning should be 63 minus the gross amounts of any contribution that would have been made either to the personal pension scheme or to the gift aid. Okay, or both. So that's how you need to arrive at the earning. But anyway, that's not necessary here, right? So this working, it wasn't necessary. So you then arrive at the taxable income. All right, so these figures they are, and that's the total that is to be subjected to the income tax computations. So one thing we need to bear in mind is that we first of all compute tax from the non-savings. Just as presented in this table, we start with the non-savings, we proceed to the savings until we reach the last type of income there. So we know that there was a a gift aid payment of 2,500, which was net amount. The actual amount this person paid or donated was 2,500. However, it is considered an 80% contribution. The state will give the contributor the 20% top up. So this brings this figure to a somehow higher amount. So if we add, so the extension of the basic rate band, okay, the revised basic rate band limit is now 40,825. Why? Because the basic band plus the grossed up amount should give us 40,825. And this is the figure which is being subjected to the 20% rate there. Okay, now we can safely see that of the 40,825, the non-savings income only consumed 37,730, which was the total amount of non-savings income here. As you can see on the table, the taxable non-savings income was 37,730. So that one is the first income to be taxed at 20%. Like I said, we need to move systematically. So we move from the non-savings income, and then we come to the savings income. Now, if the income, the non-savings income was less than £5,000, we were entitled to our to the savings income was going to be entitled to a 0% starting rate. If the non-savings income was less than 5,000%, then the savings income was going to be taxed at 0%, starting the first 5,000 of that income was going to be taxed at 0%. Then there was also going to be the 1,000 0% again, to be taxed at 0% again. That is if the non-savings income was less than £5,000. However, this income was more than £5,000, and this taxpayer was a higher rate taxpayer, which means he was only entitled to £500. So the £500 is going to be taxed at 0%. So this is why we gave a 0 there for the first 500. Then remember, we are still pushing to consume this 40,825, which is subjected to 20% tax rate. Now, because we have now entered the territory of savings income, we are also guided by the principles or the rules governing the savings income. So the first 500 is going to be taxed at 0. Now we are left with how much? We are now left with 2,595. If we add these figures, 37,730, 500 pounds, and 2,595 pounds, we are going to get this total, that is 40,825, which means at this level the amount would have been consumed up. Then the remainder now is also then going to be governed by the total of the savings income itself. Remember, part of the 4,825 has been distributed to savings income. The first being the 37,730, which was non-savings income outright, but the remainder was then distributed to the savings income. So this £2,595 of the savings income is going also to be taxed at 40%, regardless of the fact that this taxpayer was a higher rate taxpayer. But these are the impacts of the gift aid donation, which has got that tax advantage in terms of the extension of the basic rate band. So the ultimate balance here is now 1,105, which is going to be taxed at 40%. That is the part of the savings income that is going to be taxed at 40%. If you add up the figures of savings income, that is from 500 up to this figure, you will discover that they have to total up to 4,200, which was the amount of savings income. This is the amount of savings income that was considered. But please bear with me there in terms of the rules. You need to bear these in mind, because if you forget these, you will be in trouble. Now, let's move on to the dividend income. The dividend income is also subjected to a new rate band. The new rate band, the first 500 is going to be taxed at 0%. So this is why we are giving that one, and the remaining is then going to be taxed at the higher rate dividend income tax rate of 33.75. Remember, the total was 8,500 from this table of hours. The total was 8,500, but the first 500 is going to be taxed at 0%. Okay, so the income tax liability is then going to be 10,147. Now, we have been told in the question that this person once paid payee from, there was some payee which was paid during the year of 550. So we cannot double tax him. So in that situation, what we need to do is to remove the tax that has already been paid. All right, so the 550 has to be removed. This turns the tax liability into a tax payable, and the tax payable now, the amount that is actually required to be submitted or remitted to the HMRC is 9,597. This is the tax payable, ladies and gentlemen. I hope we have covered almost everything that is required. Please be careful when you have got an extended band. All right, the extended band, you need to first of all utilize the band at the non-savings income. When there is a remainder, you then have to spill it over into the other incomes, the savings income. If it is to not use the up, you then have to spill it over to the dividend income. All right, but you need to also pay careful attention to those amounts which are zero rated. As 0% taxed. Okay, you need to pay careful attention to those amounts. Otherwise, what we have done is actually justice to the question. Now, the summary. This is just a summary which would cement everything up. Whether the occupational pension scheme or the personal pension scheme, tax relief amount will be the same, but mechanisms is totally different. The adjusted income figure for restriction of the annual allowance for pensions is different to the adjusted net income figure for restriction of personal allowance. Yeah, these are two different figures. All right, and the gift aid donations are dealt with the same way as pensions contributions. So this is why, remember the G for pension, the gross amount for pension, and the gross amount for the gift aid. Those things, they were all being grossed up by 100/80 in the same manner. So they are operating in the same way. Give as you earn donations are dealt with in the same way as occupational pension contribution. Remember, occupational pension, we are deducting the amount contributed at source from your employment income. So if you also give out a donation, or if you donate under the give as you earn, you are going to suffer some deduction. All right, you are going to have that donation removed directly from your salary before any payee is remitted. So the tax advantage there is that your payee is going to be reduced. Okay, that's it for now, ladies and gentlemen, and we can call it a day. To those who are new to this channel, please, this is my number. I'm sorry, this particular slide didn't have my number. I do not know why. Uh, I'll talk to my director on this one. All right, so this is my number, ladies and gentlemen, +26377 4596 368. It's a Zimbabwean number, and it can be reached on WhatsApp or direct call. Until next time, ladies and gentlemen, may you continue to feel excited, very, very excited. I'm the Acca tutor. I am signing out there. Okay, bye.